Greetings, this is Chapter 4, Video 1. Let's launch. So today's learning objectives, we're going to be taking the tax formula and calculating an individual's taxes due or their refund. So the individual tax formula is going to be gross income minus what we would call For-AGI deductions or above the line deductions. I actually tend to prefer above the line deductions, and I'll kind of explain why here later on. Also, that's going to equal your adjusted gross income. And then we're also going to subtract what we would say from AGI deductions or what we call below the line deductions. And that's going to give you the greater, you're going to take the greater of either the standard deduction or the itemized deductions and then deduct for qualified business income. And then that's going to equal your taxable income. So when we talk about taxable income, there's also going to be taxable income times tax rate, which is going to equal the income tax liability plus other taxes. Now, some other taxes that we're going to have is going to be things like self-employment tax. We could also have what we call net tax, which is net investment income tax. There's also going to be the additional Medicare tax. There's also going to be some other taxes that they may have, for example, some penalties or anything of that nature, what we call, the penalty tax, like the 10%. If you take out your 401k before you're supposed to, you may have an additional tax on that. Then you're going to subtract out the credits that they're allowed. Now, in this class, we don't talk too much about credits. My personal opinion is take one of the slides that I've actually uploaded and go ahead and do some review on that, because if you take a look at that, it's chock full of information. And quite frankly, when we build these classes, we have to kind of pick and choose what we're going to talk about because there's just not enough time in order to be able to hit every topic that we've got. But the tax credits is going to be a very valuable section for you to be able to talk to your clients about in order to save them money that they're entitled to under the law, because those tax credits are done for a whole host of reasons. Sometimes it's basically, Congress wants to encourage people to have families, so they have the child tax credit. Congress also wants to encourage energy savings, so they've got the energy saving credit. They also want to encourage people with lower income to save for their retirement, so there's a lower income retirement savings credit. So there's different types of tax credits that people get to take that are very valuable. But the most important tax credit that you guys probably care about are the education tax credits, because those are things that you get to take right now. The American Opportunities Credit, the Lifetime Learning Credit. And in this class, I get a lot of students asking me questions about those. And I would actually recommend that you take a look at those and see if that might be something that you should be taking on your own tax returns. If you have any questions, I do field those questions with clients. Usually I start off with, okay, I'm not talking to you as your professor. I'm talking to you as a tax professional and knowing your circumstances, whether it's good for you or not to be able to do this. So I might ask you some questions, but I'll definitely be able to help out. Then you're going to subtract out prepayments. So for example, if we had you do income tax withholding on your W-2s, income tax withholding on any 1099s that you've got, and then also any type of estimated payments that we recommend to you. And that's going to equal taxes due, or if prepayments is greater than the total tax after credits, you might be getting a refund. And obviously that's what everybody hopes. They hope they get a refund. So individuals are going to report their taxable income to the IRS. They're going to report it on Form 1040. This tax form has actually gone through a lot of changes. So when we go back and we talk about, tax deductions that are taken from, For-AGI versus From-AGI, that AGI is actually what we refer to as the line. Now, traditionally, why we call it the line is because that was the bottom of the tax form back in 2017 and before. And then, of course, when you flip it over, you have to understand a lot of these tax forms were made back before computers were done. And so in order to make sure that they transfer over the correct number, they would go ahead and they would say, okay, we want you to copy, the previous line onto the top line of the next form. So we called that the line. And that's a very important number in order to be able to have calculated correctly, because that's going to get you to a whole host of other deductions and opportunities that we'll talk about when we get into those chapters videos. U.S. tax law use all-inclusive income concept, which basically is that we have two forms of income. We have realized income. We have recognized income. Realized income is generally going to be larger than the recognized income because there's going to be certain tax deferral schemes or other opportunities for them to either defer recognition or not recognize it altogether. And so the realized income is measured as measurable change in property rights. That's kind of the legal definition of what realized income is, but it's all realized income, including gross income, unless specifically excluded or deferred. And that's something that a lot of your clients are going to run into. So for example, if I have, I have staff who work out here at my firm, and I tell them, hey, look, I'm going to give you a $50 gift card to, because you worked real hard this tax season. Here's a $50 gift card. Technically speaking, that is income to the employee. Now I had to go to my paychecks person and I had to say, hey, look, I gave them a $50 gift card as a result of some of their hard work that they've done. And so they went ahead and they checked that into their income so that they made sure that they withheld appropriately. And generally speaking, the United States kind of takes it from the perspective of we're going to tax you on everything unless we tell you specifically otherwise. A very good example of income that's excluded is going to be your tax-free interest payments that you receive. So for example, if you have, bonds from Virginia and you get paid interest from those bonds in Virginia, it's a municipal bond. So what ends up happening is the federal government says, look, we're not going to recognize any income from those because of certain natures of those. And we'll get into that when we kind of talk a little bit more about that. Again, on recognized income, it's going to be that which is reported on the tax return. So, and I actually hate the way that they did that. So first of all, these slides actually weren't done by me. They were done by the textbook. But they say it's reported on the tax return. There's actually a lot of tax exempt and deferred income that's reported on the tax return, but not necessarily taken. So I would actually argue you're going to report 100% of your income onto the tax return, but whether it's taxable or not, it's going to determine whether it's recognized income or not. So again, exclude or deferred income, not including gross income. This is where we kind of talk a little bit about it. Income never included in taxable income. Is the definition of excluded income. That's going to be your municipal interest, gain or sale on personal residence. So if you, like I said, if you want to do an investment vehicle and you're looking for some tax efficiency, and we actually talked to some of our clients about this, hey, we can get you into some of these other investments that'll do tax efficiency. They may not be the most financially best vehicles, but if you're looking for ways to lower your tax liability, they can be very good for achieving that goal. Again, my personal opinion is, if I'm going to get you a bond that's going to pay you 3% per year, or I'm going to get you a stock that's going to pay you 8% per year, but tax you at a 15% rate, I'm going to take the dividend any day of the week and twice on Sunday. So that's something that you need to kind of take a look at. Don't just say, oh, well, I'm going to do the thing that's going to be best for you to not pay taxes. Because if you think about it, if I was going to do that, for example, I would basically say to somebody, you don't want to ever pay taxes again? Good. I got a way to do it. Move to Washington, D.C., take all of your money, put it into municipal bonds, because any bonds in the United States, when you're a DC resident, are not taxable in DC. You're not going to pay tax on the federal government. You're also not going to pay taxes on the DC government. And then you have Social Security. You're not going to pay taxes anymore. Now, is that the smartest move to be able to do? I don't necessarily think so. I think that there's some other opportunities that we have in order to be able to better mitigate some of that stuff. And sometimes what ends up happening is it's the tax professional, it's the financial professional. They get together, they work together, and they try to find ways to be able to do that. So deferred income is income that's included in a subsequent tax year. Good examples of those are going to be your installment sales and then your like-kind exchanges. Installment sales, which basically is, hey, I'm going to buy a house from you, but I don't have the cash to pay for the house up front. So what I'm going to go ahead and do is I'm going to pay you over time in order to be able to get that house paid off so that I can actually get that at that time. And then the like-kind exchanges, that's basically where if I'm swapping two things that are similar. Now, in the old rules, back in the old days when we did like-kind exchanges, it was basically anything that was similar. So for example, I have a microphone. Say I spend $5,000 on this microphone. I did not spend $5,000 on this microphone. It was more like 60. But if I spend $5,000 on this microphone, I sell it and I go buy another microphone, I could do what's called a like-kind exchange, so that I don't have to recognize the gain on the income from selling this microphone. Now, generally, personal property tends to depreciate in value. So there wasn't a whole lot of like-kind exchanges happening with tangible personal property. Happened more often with real property, and now the tax law only allows it to happen with real property. That said, it doesn't mean that it doesn't happen on a financial perspective. So if you do like-kind exchanges, I'm going to swap this microphone for another microphone. We're going to call it an exchange. There's some financial accounting treatments that get done with that, but the tax system will not allow you to defer the income on those types of those transactions anymore. So the character of income or loss, character is something we talk about a lot, and not only character of accountants, but we also talk about character of income and losses. And it's going to determine the type of income that you've got or loss in the year. It's going to determine whether it's tax exempt, meaning no tax, or tax deferred, meaning no tax this year, but maybe next year. It's also going to determine whether it's ordinary, where you're going to pay ordinary rates. Could be qualified dividends that are taxed at what we call the capital gains rates. And you can have long-term capital gains rates. That's something that's actually not on this slide, but it's definitely something that you have. And we've talked about this in other areas, but when you have your 3 tax rates, and I talk about this in a video that I actually do for my business. I'll try to give you guys the link to that, where we talk about capital gain. There's 3 rates that you got to learn for them, and that's marginal rates, marginal rates, effective tax rates, and then your capital gains rates. And those are going to be some things that you have to take into account. And so when you have those different types of tax rates, if I can get you from ordinary income to the capital gains rates, that's going to get you a much better tax effect, because it's usually a lower rate. So if you're in the 32% bracket, maybe you pay a 15% capital gains rate. I'd rather have you pay 15% than 32. You see what I'm saying? So you want to be able to go with that and give them that best advice so that they can make sure that the character of their income is actually done better. Now, of course, more often than not, we're dealing with this in the after effects. Then it's just making sure things are done correctly so they can get the correct liability calculated. Capital gains or losses are going to depend on whether they're short-term or long-term. And I kind of hinted on this with the last slide. They didn't put it there. It was actually here. I forgot about this. But, capital gains or losses, short-term or long-term. So short-term rates are going to be at ordinary rates. But if the asset is held for a year or longer, it's going to be determined to be a long-term capital gain, and then capital gains, and it's going to be taxed to those long-term capital gains rates, which are preferential rates, which is going to be your 0, 10, or 15%. Capital assets, generally all assets are going to be considered capital assets, except for the following: accounts receivable and inventory, and then assets used in trade or business, including supplies. So here's the thing. So why accounts receivable and inventory? Well, the reason why is because you own inventory and you own accounts receivables with the intention of converting them into income for your company. So if say for example, I have a comic book store, I actually, when I was growing up, I used to watch a lot of Japanese animation. So maybe I sell Japanese animation to kids who come in and want to buy animation from my company. So they come in and they do this, and they're doing that. I buy the inventory from the wholesaler, who gets it from the producer of the good. They give it to me. The wholesaler gives it to me, and I sell it to the consumer, and the consumer then goes ahead and they consume it. Well, what ends up happening is I buy that with an intention of converting that to ordinary income. Therefore, they're not going to give you the capital gains rates on that without, because you have this explicit purpose of converting it to ordinary income. Accounts receivable is kind of the same thing. So if you come to my firm, I do your tax return, and you take a month to pay for it, that's an account receivable. It's going to convert to an ordinary income. So if I decide to go ahead and factor my accounts receivables out, I can't go to the IRS and say, oh, wow, it's a capital asset, I want capital gains rates. They're going to be like, sorry, Chuck, go away. And so they're going to go ahead and they're going to prevent you from doing that. Now, there's also assets used. They're saying supplies. I think another example of this, and we'll talk about this later on, capital, another assets that are used, 1231 assets, 1245 and 1250 assets, even though they receive capital gains treatment, They're not necessarily always going to be considered capital assets, but it's kind of a weird nuance because from a financial perspective, they are capital assets, but technically from the tax code perspective, that's not seen as capital assets. Those are assets used in a trade or business, which is why they qualify for Code Section 1231, which then of course ties into 1245 and then 1250. Capital gains and losses. So what's going to end up happening is you're going to net your long-term capital gains and losses in excess of short-term capital gains and losses that are going to be taxed at either 0, 15, or 20%. And the way this is going to work out is that if you take a look at a tax graph and you take a look at the capital gains rates, and I actually have that like right here. I have a very good book that actually does this. I wish I could show this a little bit better, but basically what they have is they have the various tax brackets. So you got 10, 12, 22, 24, 32, 35, and 37. So basically the way it's going to work out is if your ordinary tax bracket rate is 10 or 12%, you're going to pay 0% capital gains rates. If you're taxed at the max rate of 37%, you're going to pay a 20% capital gains rate. And if you are taxed anywhere else, it's going to be a 15% capital gains rate. Now, some of you might say, oh, okay, so if I sell a whole bunch, say I sell $250,000 worth of stock, but my only other income other than that is Social Security, does that mean that I don't pay any taxes on it whatsoever? And the answer is no, because they're going to determine your income based on how much income you have as a result of that. Now, part of that's going to be 0%, part of it's going to be 15%. And if you're single, it's entirely possible. I mean, I think actually, no, with the single, I think it goes up to... Yeah, so it actually goes up to 500,000. So you would still be at the 15% rate. I had to look that one up because these new tax rates. I mean, I'm getting pretty good at them, but sometimes it's not 100% there. But then you got short-term capital gains that are going to be taxed at ordinary rates, as I said before. Net capital losses. So say for example, you've got net capital gains. Short-term capital gains of say $10,000. You've got net long-term capital losses of $30,000. So you take the two, you got $20,000 left over. What happens? You can take $3,000 against your income immediately, and then the rest of it carries forward indefinitely. Now, if you're married filing separate, you take half of that. But other than that, everybody else gets $3,000. So that's very important. You want to know that because that's going to be on your CPA exam, I guarantee you. And it's definitely something that's important for some of the homework that's going to be coming out. All right, so the individual tax formula, again, we're talking about the deductions for AGI. I actually hate this term. I like above the line, below the line. And here's why. I studied Japanese for many years. And one of the things that used to really confuse the living bejesus out of me is when I had to learn two words that sounded very similar. And if I mispronounced one, next thing you know, I'm saying something completely different. And anybody who speaks Chinese, you're really going to know this because you got those four tones. The four tones in Chinese, you got ma, 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 ma. And, there's like all five of those words is completely, I'm sure the Chinese people are listening to this going, my gosh, what's he saying? Because my wife laughs at me every time I speak Chinese. It's always a comedy show because I always say the wrong thing. She starts laughing hard. It's actually really kind of cute. But so what happens is that deductions above the line, and that's what this is, deductions above the line. So it's going to be deducted in determining your adjusted gross income. Now, why is this important? Adjusted gross income is going to determine some of the deductions that you take from AGI or below the line deductions. So you want to make sure that your adjusted gross income is calculated correctly. But also, if I'm doing some tax planning, I have an opportunity to take something from AGI and move it to For-AGI. It's a great thing. Something that's happening as a result of the CARES Act that just got passed recently, $300 is now going to be deducted as charitable contributions above the line. So now what ends up happening is I get to reduce my adjusted gross income by $300 because of that. So it became a much more valuable contribution. Now, personally, I wish it was more than $300 because, there's some people I think who would give a lot more. And all that sort of stuff. But, I'm not here to debate tax policy. I'm just here to tell you, I'm just here to tell you what it is. Okay. So you just go with that. So some come on AGI deductions. So alimony, one of the things that happened was, and we'll talk about this when we get to the deductions portions of this class. Alimony rules changed drastically in the last tax law. Basically, any divorce that takes place from 2019 going forward, is going to basically, alimony is paid tax. It's not taxable income to the recipient. Now, it sounds like a really cool thing, but if you're, a person who, you get divorced and you got to pay alimony to an ex-spouse, you can say you're making $400,000 and maybe you have a spouse who doesn't make all that much money. All of a sudden you're paying tax on $400,000 and your spouse is not paying all that tax. Part of the reason why they did that, I think, was because the audit ability of that for the IRS, it was actually very difficult. Sometimes what would happen is money would change hands. They wouldn't necessarily, as long as the two agreed, nobody really ever questioned any of it. And I think that it actually got to a point where the IRS was like, enough of this. We don't want to deal with this anymore. And so when they started doing the tax legislation, I think some people were advocating, let's do this so that we can reduce overall audit costs for the IRS. You also have rent and royalty expenses. So, and this actually isn't technically, it is above the line, but it's actually in the income section. And so like, very good example. If I own a business and I make $100,000, but I spend $40,000 to make that $100,000, that's a deduction from that income. It's that net income that really shows up on that line. It's kind of the same thing with rent and royalty expenses. I got, maybe I get $25,000 in rent from a house that I have, but I spend, $20,000 in order to maintain that house. And, the taxes, interest, depreciation, all that stuff. Really, I've only got $5,000, but it is a deduction that if I can move it from Schedule A to Schedule E, it becomes far more valuable. And I think that's very important. Okay. And then contributions to qualified retirement accounts. Some of you, there's various limits on this, but if you want to make a contribution to a traditional IRA, you can actually reduce your overall tax liabilities, and that can be very helpful. Deductions from AGI, again, just kind of scratching the surface. These are what we call deductions below the line. I usually refer to it that. I hate for. Again, deductions below the line. Deduction for qualified business income. This is actually a brand new one. So what happens is that if you have qualified business income at 20%, it's technically not an itemized, actually not technically, it is not an itemized deduction because it's outside of the itemized structure. But what happens is this is a business income deduction. We actually have a slide a video series where we're going to talk about this. It's going to be a real quick one, hopefully. And then that'll be very useful for you guys. And then you're going to take the greater of the standard deduction or itemized deductions. And then, so if you have, so say for example, you pay mortgage interest, you pay taxes and all that sort of stuff. And then you calculate it out and it's only $20,000 and they're married filing joint. You're going to take standard deduction because that's going to be much higher than if they were to actually take the, if they're going to take the itemized deduction. Now, there are some times that you may want to do the itemized deduction. I actually had a case this last tax season where it was funny. Actually, the client brought it to me. I was embarrassed because I didn't think of it myself. But, the cool thing about it was, hey, if I take the itemized deduction, yeah, I'm going to pay $500 more in federal taxes, but their Maryland taxes went down by $1,000. That was a big help to them. And so it's something that you sometimes want to take into consideration. Maybe you want to elect to go ahead and take itemized even though. Could be a good deal for you. Some kind of common itemized deductions. There's mortgage interest, state income taxes, charitable contributions, and the like. All right. So the 2020 standard deduction amounts, it's going to be $24,800 for married filing joint, and so on and so forth. You can read this slide. This is something you probably want to have as a quick reference. In addition for my test, but you also probably want to have it as a quick reference if you're going to be doing individual tax returns. Again, normally most firms, every firm I've worked at, they always buy these, and this is what we call the quick finder. And I'll see if I can, well, actually, I can't give it to you guys because I only got one copy. But the quick finder, this is going to be chock full of information that's really quick to find. So if I'm sitting there having a tax planning meeting with a client, I'm like, hey, you're married filing joint, you're making $300,000 a year, your tax bracket is now 24%. That's useful information for me to be able to give to my clients so we can make sure that they actually get the good tax deductions and tax advice so that they can make good decisions. Because as we talk about with marginal rates, what's marginal rates? Marginal rates, another word for marginal rate is decision rates. It's going to help me make better decisions so that when I'm trying to decide between buying this or not buying this, the marginal rate on that tax return is going to be my decision rate to help me out. The tax calculation. So the U.S. tax system uses a progressive tax rate schedule. Remember back in chapter 1 when we talked about progressive tax rates? A very different system than exists in other countries. A lot of countries that I've dealt with are either progressive or flat rates. Obviously, you're not going to have a whole lot of regressive. I mean, the United States does have a regressive system, as we talked about in the past. It is Social Security, because once you hit a certain amount, boom, it's done over with. So it's going to range from, like I said, 7 brackets from 10 to 37%. Some taxes are taxed at preferential rates, and that's going to be your long-term capital gains, your qualified dividends, and then also, tax on these items are calculated separately from income taxed at ordinary rates. So what will end up happening actually on your tax return is that you're going to actually fill out what's called a tax reconciliation worksheet. Actually, you're not going to fill it out. Your computer's going to do it for you. You're going to look at it, make sure it looks okay, and that's going to be good for you on that sense. So we want to make sure that we're taking a look at that and then seeing how that kind of works out. And you want to take a look at that because I actually showed that to my staff during tax season. He's like, "Wow, I never knew this thing existed." And I said, "Yeah, I understand. But this is very valuable when you're talking to your clients and they say, 'Hey, I'm thinking about buying a car. What's the tax effect to me?' Well, what's your tax rates? What are your marginal tax rates? How far are you into that marginal tax rate? If you're $3,000 into that marginal tax rate and you're going to buy an $18,000 car, I'm not going to necessarily use that marginal tax rate. I'm going to use the blended of that rate and the rate lower to it. If I tell them it's 32% deduction, but they're only $3,000 into 32%, it doesn't make any sense. See what I'm saying? So you got to make sure that you're actually taking a look at that and making good decisions with that. Okay, because even though it's the decision rate, we got to be good about how we do the decisions on the decision rate. Okay, other taxes include AMT. Not so much nowadays. The AMT was actually jacked up. Corporate ways, it went away. And on individuals, it got jacked up so high, sky high, that most people don't get it anymore unless they're, part of the 1%. So they'll be dealing with that. Self-employment tax is something that we deal with a lot here at Beta Solutions, but also out in the accounting world, because a lot of times you'll have self-employed individuals that are going to be part of that factor. And then you've got the 3.8% net investment income tax, the 0.9% Medicare tax, and then you're going to have tax credits, which are going to reduce dollar for dollar that tax liability. And that's very valuable because if I get a deduction, it's only going to be at a percentage of my marginal rate. So if I have a marginal rate at 24% and I spend $1 on something, I'm only going to get 24 cents of benefit on my tax return. If I spend $1 and I get a dollar for dollar credit, that's money in my pocket. That's actually really good. So if you can get your clients and have them understand a little bit more about some of the tax credits and some of the benefits that they can get with that, you can actually do some good value for your clients. Pre-tax payments, tax payments are already made. And, so for example, if you have, income taxes that are withheld, either from, it could be state, could be federal, whatever. Then you have, obviously the state, you're going to go on the state return, but you will have withholdings, estimated tax payments. So if I go to my clients and I notice that they're not withholding enough, my system's going to say, take 100%, 110% of your tax liability minus your withholdings. This is your estimated tax payments that you need to be making. And that's going to be important to educate your clients. Hey, if you're not withholding enough, you got to make these estimated tax payments in order to avoid an under withholding penalty. It's going to be very important. Okay, so taxes overpaid in the prior year are applied towards 1 year's another liability. So for example, I get done with a tax return and I notice he's got a refund of $10,000, but he's got quarterly payments due of $8,000. I might go to my client and say, "Hey, I got a good idea. Why don't we just withhold $8,000, send it to the federal government right now as part of your refund, give you $2,000 back, but your $8,000 that you get back from that is going to more than, it's going to cover your estimated payments. You'll be good to go." And that's something that we can actually do for them in order to help them out with that. If prepayments exceed tax liability, taxpayer gets a refund and they're living La Vida Loca. All right, folks. So that's all I got to say about this class. I want to say thank you very much for watching, and I look forward to seeing you at the next class.